And good morning, everyone. As you see the title, the Wayfair decision, a game changer for e-commerce, I think back to the fact that I've been involved in sales tax for quite some time, not all the way back to 1921, but that was when sales tax first kicked in. West Virginia was the first state to enact a sales tax, and they had no idea what they were starting. The tax back then was only 2%. It was only on a small amount of consumer goods. They absolutely had no idea about the taxing services, and certainly not on remote sales. But life has changed. There are now 10,000 jurisdictions that tax sales tax, including localities, cities, states, counties. And really, what has transpired has been enormous. Within 15 years of the West Virginia case, there were 25 states that had it, sales tax, and now it's in 46 jurisdictions, including Washington, D.C. But the new expansion just this year has really been based on the Wayfair decision. And what that did came down first day of summer this year, June 21st. And really what the issue involved was out-of-state vendors. Out-of-state vendors had been left off the hook from any kind of sales tax collection. And the reason was Nexus and the state laws that had been enacted had to follow various Supreme Court decisions. One was in the 60s, and then there was a follow-up, Quill, in 1992, Quill versus North Dakota, which essentially said that if you didn't have physical presence in the state, you didn't have to collect sales tax. Didn't mean the sales tax wasn't due. It meant that all of us in this room had to theoretically remit sales tax when you hadn't been charged. So if there was an internet sale, you didn't have to pay, you were supposed to be paying your own sales tax. Most people either didn't understand the rule, didn't want to understand the rule, didn't know the mechanics of how to pay. Most of us, frankly, and I'm not, no lie detector tests here, but most people didn't pay it. And most businesses, frankly, didn't pay it either. So what happened is the state said, yeah, we have a lot of revenue, but it's not enough. So what they started to do was try to chip away or expand what physical presence was. That was step one. If you had sellers of your goods in a particular state, that was sufficient to create Nexus in a lot of states, and there were Supreme Court cases that came down on that. If you had an affiliate in a state, that created Nexus. That was considered physical presence. And then there was even something called Amazon Nexus, which is kind of ironic, because as Gabe and George were talking about today, and it's hard to leave them out of any e-commerce discussion, Amazon at first was refusing to collect sales tax, but they ended up having physical presence in a lot of states because of the short time frame that they wanted to have goods delivered, whether it was 2 days or 2 hours. They have warehouses in a lot of locations, physical presence, so that consisted of physical presence nexus. So with that being the framework, the states still weren't happy. They said, you know what? We're leaving $13 billion off the table. And it's really not our fault. It's just the way these laws have picked up. And so that was the genesis of economic nexus. And what economic nexus is, the easiest definition is really having a sufficient amount of sales into a state. You'll see all highfalutin type of definitions, but when it boils down to it is, if you have a sufficient amount of sales in a state, you're subject to sales tax in that state. So states started to do this despite the fact that there was the Supreme Court case that was clearly being defied. One of the states was South Dakota, and it's interesting that the Dakotas have been one of the leading proponents in the state tax world, affecting everybody around the country. So South Dakota had basically said in 2016, we want to collect for any sales coming into the state remotely. We don't care about the Quill decision that says physical presence is mandatory. And they came up with the concept that if you had $100,000 of sales, or 200 separate transactions. Theoretically, that could be $201 transactions. You had sufficient presence to be required as an out-of-state vendor to collect and remit sales tax. So naturally, this was challenged by Wayfair and Newegg and some other online vendors. And it went up to the Supreme Court. And the Supreme Court held against the state and for those vendors because, hey, we're the state Supreme Court of South Dakota, but guess what? The Supreme Court of the law the Supreme Court of the United States ties our hands. We can't do anything. South Dakota legislature, you lose. But the state appealed, and they asked for certiorari to be granted cert at the Supreme Court level. And typically, at the Supreme Court level, they only take about 1 in 20 cases. They took this case because they thought it was important in terms of the national interest. And what did they come down and say? They basically said, because the physical presence rule of Quill is outdated, it creates an unlevel playing field, et cetera, it is incorrect and unsound, and it is overruled along with National Bellahess, the earlier case. It was a 5-4 decision, and in logic would dictate, and there was a lot of pressure from the states and some pressure from brick and mortar stores that were saying, this has been unfair to us. Though I'm sure Gabe and George would agree, most brick and mortar stores have tried to go online as well. So there really isn't, there's becoming less and less of a difference. So they came up with a test, and there's what the Supreme Court said, that whether the taxpayer avails itself of a substantial privilege of carrying on a business in a state. That's Supreme Court talk for basically saying, if you have a significant amount of sales in the state, you're going to be subject to tax. And the taxpayer in that case was. So what are the immediate things to be thinking about? This applies to all internet sales, and that's the big target area, no question, but also any catalog sales, and it could even be something as simple as a retail jewelry store. You come in, just to use Tiffany's as a name, you buy something in New York, and many people may be familiar, they would ship an empty box to your house in Connecticut, not charge sales tax. Looks like an out-of-state delivery, and they wouldn't have to collect sales tax. That's no longer going to be a possibility. Same thing with art dealers. If you had an art dealer in a particular location, they sell a painting for $200,000. One transaction, shipping it off to a random state, they'll have to collect sales tax. So a lot of the states already have come up with laws similar to South Dakota, and it's incredible how fast this happens when there's revenue on the table. In this case, it's like free revenue to the states because they're not challenging, they're not taxing any of their in-state constituents. No voters get hurt by this. When this law is enacted, it just means you're collecting from out-of-state vendors. So they were very happy to move very fast. And right now, I have in the slides, and again, George mentioned, we got these slides in early. Since I got that in, there were 28 states that had enacted the legislations, now 31. I anticipate that probably by the end of next year, all 46 jurisdictions are going to have some type of Wayfair legislation that kicks in. So in terms of the other states, initially, and this is changing already as we speak, it's rapidly developing. Some of the states are trying to apply this retroactively because they were the states that had gotten in early before Wayfair came down. Slowly that's changing. They're saying, forget the earlier years. We'll start from the day that Wayfair kicked in. So about 6 weeks ago, on October 1st, the laws of the first 10 states kicked in. They're up there on the screen and in your handout. And for the most part, they're mirroring South Dakota's law of $100,000 of sales or 200 transactions, but not exactly. As I mentioned, it's now up to 31 states that have the law. And originally, I thought it would be by July 1st. From the way things have slowed down in some states, probably by December 31st of next year. So here's just a comparison. And again, if you can't see the screen, it's in your handout as well. South Dakota being, the model state, since that one has been approved by the Supreme Court. But looking at other states, Arkansas is one that has proposed legislation, but it hasn't passed yet. There's no date given. Connecticut is one of the more generous states to taxpayers, or really to the vendors, to collect the tax, basically saying you need $250,000 a year in sales and 200 more separate transactions. Connecticut actually happens to be pretty sophisticated on this issue. They've already been dealing with marketplace providers, meaning the Amazons or the Etsy's, or not Etsy, but more like the eBays of the world that are the marketplace for these, and been able through them to collect some sales tax. So they have a feel for it. The starting dates, as you could see on the screen, have varied, and there are some that are now in 2019, January 1st, April 1st, July 1st, when other states are kicking in. New York, interestingly enough, is not one with any legislation. New Jersey has a certain threshold where they specifically say this applies to sales of tangible property, digital property, and services. So while they're specific, but I'll compare that to Illinois, one of those 10 states that kicked in October. Their threshold is only to a retailer's sale of tangible personal property. So it's much more limiting. So this could help various companies if they don't want to collect in all the possible states. There are some companies that we've dealt with that said, just check the switch on for all the states. We don't even want to deal with this anymore. But there are others that, wherever they can, want to be as competitive as possible in terms of their pricing. And leaving out sales tax is a great way to reduce your sales tax by 6, 7, 8%. Interestingly enough, sales tax have crept up, and in some states it's over 10%. So that can be a significant difference. For the most part, this is a retail issue, but the way the laws are drafted in most of the states, it could affect anyone. Certainly if you have mixed sales, and I know there's a whole bunch of those where vendors are selling both at retail and wholesale, you have to be concerned. But even if you're merely a wholesale or a distributor or a manufacturer, the laws are written that you could get over those thresholds and have a collection responsibility. Now, there is a way out, of course, that's if you collect the resale certificates in those states. So it's a pretty big administrative issue. And I would highly recommend, even if you don't start filing in those states, wholesalers and manufacturers, collect those resale certificates. It can be a nightmare to go back and try to collect these down the road if you ever get audited. What I typically recommend to clients who are in that type of boat is to start filing in those states. Yes, there's an upfront administrative burden, and even if you don't owe a dime of tax, by filing 0 returns in a particular state, you trigger the statute of limitations. So a state, if they did come in and wanted to look at you, would never look back more than 3 years. 10 years down the road, that could be a big issue. It also could be a big issue if a company wants to sell itself. If there's an M&A situation and they see you haven't been collecting, down the road, this is going to be a big deal. Buyers should also be aware. I told you that some of our clients, at least, have said, just turn on the switch, I'll start collecting tax from everybody in every state. Well, if you're selling at wholesale, that buyer is not really subject to having to pay the tax. But who's going to be checking that? It has to be the purchaser. It has to be the accounts payable department. They have to be vigilant. Look at your purchases. Make sure you're not paying sales tax that you don't owe. And that goes for other types of entities as well, nonprofits, manufacturing. Anyone who, when they make these purchases, should not be subject to sales tax, don't pay it. Go back to that vendor. Someone asked me if I'd seen any surprises, and I'd say yes. The states will surprise you. I guess it's not so surprising that Iowa, when they implemented this, the Wayfair sales tax, said, you know what? While we're at it, we're going to expand our base and let's start taxing services as well as goods. A double way of bringing in revenue. The other side of it is probably much more surprising. Wisconsin and Minnesota actually said, you know what? This is extra revenue. We have always maintained our budget. We don't necessarily need that revenue. Maybe there's other ways that we could cut other taxes, such as income tax. I mean, how refreshing is that in the tri-state area? You're never going to see that, at least not in our lifetimes. But one thing that would be interesting, it actually hasn't happened, would be if federal legislation came down on this. And really, to touch on what that is, in September, a couple months ago, the federal government, there was proposed in the House some legislation that would sort of systematize everything. It was going to be one starting date of January 1st, and also there was going to be a small business remote seller exception, which basically says if you as a company didn't have 15 days in a state and had 10 million or less in sales, you didn't have to worry about this until the day you went over your that $10 million number. But as with a lot of legislation in the way everything is lined up federally these days, it's highly unlikely that this is going to pass this year. And if it will ever pass, it has to be reproposed, for example, next year. Income tax consequences. I mean, I'm really here to talk about sales tax, but income tax is the next frontier. There are actually 12 states that subject you to income tax remotely, even if you don't lay foot in that state. The typical threshold in those states is a little higher than what we were just talking about. It's about $500,000, but it's out there. And one problem that we're already starting to see is once you register for sales tax, you become on the radar screen. And we're seeing questionnaires pop up asking, where's your income tax? Now, usually, at least in the situations that we've been involved, there are no income tax consequences, but it's a little scary to get that notice, and there could be future consequences down the road. So, what are the next steps? If you're in this situation, even if you're a manufacturer, even if you're a wholesaler, even if you have exempt folks who you are selling to, you have to start looking at what your footprint is. I would recommend the sales tax nexus analysis. When we've done this for our companies, we found that they already had physical presence that they were unaware of. Even if you attend trade shows in some states, that's sufficient presence if you go there. So you have to start gathering the data, see where your priorities are. Make sure you're not running into income tax issues. Calculate your exposure. If there is back year exposure, start looking at a voluntary disclosure agreement or amnesty. Right now in Connecticut, not a lot of time, but there's 2 weeks left in an amnesty program. There is also New Jersey has enacted an amnesty that will last until January. That's ongoing. If you have Nexus, you still may be able to get off the hook in some situations, depending on who you're selling to. We talked about wholesalers. If you sell to wholesalers, that's not going to be subject to sales tax. Some states are just looking at retail sales. There are other ways. If you sell to manufacturers, if you sell to exempt orgs, you might be able to avoid any type of sales tax collection responsibility. One issue that has come up that I've seen is bundling of services. The classic example of bundling is the cheese board and cheese example. Cheese, typically, food is often excluded. A cheese board, a tangible property, is taxable, subject to sales tax. Whenever you combine two items, sell it. People used to buy these as gifts, cheese and cheese boards. That would be subject to sales tax. Today, the modern day example is really computer software. If you're selling customized software, that's exempt. If you're selling licensed software, Microsoft Office, just as an example, that's subject to sales tax in many states. You bundle those two services together, it's all subject to sales tax. So one of the issues you may want to look at is unbundling. Technology and personnel. Do you have, as a company, do you have sufficient technology? Do you have the right personnel to handle this increased burden? If you were filing in 2 states and you're now going to be filing in 40, that's a lot of compliance. And sales tax, depending on the level of sales, can be monthly. So it's a lot. Also, I told you we've started to see notices. The next step after notice is down the road, you're going to see more audits. So that's probably built into the equation. Know that this is coming. Consider your situation. And in terms of outsourcing, you may want to think about outsourcing the compliance. The last step, and it's interesting, we have different categories of our clients. Some that are fully knowledgeable, and it's very impressive. Some, on the total other side, they're saying, what do I do? I have no idea what I need to do. And then you have others that are in the middle. They understand what needs to be done. They just haven't gotten started. And that sometimes is the hard part. Start complying. If you need to register, registering with the Secretary of State may not be needed in a Wayfair situation. We're finding states actually aren't requiring it. But you still need to register with the tax departments. And just to go back to the Secretary of State one, if you have physical presence, you do need to register. If you have Wayfair, economic nexus, you don't. And prioritize. You don't have to do this all at once. The dates are trickling in. There is a little bit of time. Go with the big states. Go with where most of your sales are, and really begin collecting and timely remitting. The final thought is also you got to keep up. There's been a lot of changes, and if you're in this area, beware of what's occurring.